We've had the third straight day of above average losses on heavy volume. Today, a lot of it was blamed on some of the trade news that we heard out of the White House. Sounds like there might be some tariffs coming in on steel and aluminum. So we'll take a look at a few of those players here today, along with the rest of the markets. And we're going to take a look at a recently weakening sector for our trade application example for the day. Let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee. It's March 1st, 2018. Welcome to the video. If this is your first time, we're certainly glad to have you here. If you're a regular viewer of ours, we certainly appreciate that as well. Remember, if you are new to YouTube, there is a subscribe button there in red that you can click on, and that bell icon will also notify you whenever we upload those videos to YouTube. In addition to that, if you appreciate these videos on a daily basis, be sure to click that thumbs up button there for us. And if you have any comments for us, scroll down to the bottom, click on the comments area, type out your comment or your question to us, and let us know what you think about these videos. In addition to that, we do have a description area that you might want to check out some of those links in there. One of those links will allow you to sign up for our daily email reminder, which does include some of the overbought and oversold cluster signals of the S&P 500 stocks. Today I just checked and there were about 54 oversold clusters in the S&P 500. So over 10% of the entire index is showing us oversold clusters. Now, in addition to YouTube, of course, David and I are heavy users of Twitter, so we'd encourage you to follow us there. My handle is at Brandon Van Zee, all one word. Our Market Scholars handle is at market_scholars. And remember, we always pin our most recent Market Outlook post to the top of our Twitter feed. So if you appreciate these, we would certainly appreciate it if you went out of your way to click the like and the retweet button. I did just check and see that we had over 100 likes here on the last time I did the video, so I definitely appreciate that. Keep up the great work there. Now, in addition to Twitter, we're also on Facebook, so make sure you check out the web address there for our Facebook group and join in on all the fun there. All right, so let's go ahead and take a look at the markets here. As you can see, the S&P 500 did fall by 1.33% here today, as mentioned in the intro. That's our third straight down day. And you can see it did some fairly decent technical damage to the chart there. Yesterday, we were kind of left hoping that maybe we'd find a little bit of support in that area, but we did find that today sliced through that prior horizontal support area that we had on the S&P 500 close to 2,700. So as it stands right now, we're at 2,677, and you can see that that was enough to bring the posture of the S&P 500 to a slightly bearish posture. Remember, that happens when this green intermediate term line on the market forecast indicator starts trending lower, and that is where we stand right now. And that's why the background color of this chart is pink as well. Now, in addition to that, we also have price below a falling moving average, and that's why that moving average line right there is colored in red. That's your 30-day moving average in this particular case. If we take a look at how the market's action affected the other three indices, let me pull up my next set of charts here. And you can see that we have a theme across the board. We do have bearish postures across the board, no matter what index you're looking at after today's action. The NASDAQ had done a pretty good job of holding up and withstanding some of the recent pressures, but you can see that even after today, we now have that NASDAQ where that green intermediate term line did start rolling over just a little bit. Remember, sometimes it's hard to see with a naked eye whether that's up, down, or sideways. And so remember, the labels that I have right here will help give that away for us as well, because it's actually reading the levels for us. And it says 77, 46, and falling there on the NASDAQ. So across the board, whether we're looking at large cap, technology oriented, or even small cap, we do have bearish postures using that market forecast indicator. Now, one thing I will note is that the Russell 2000 did a pretty decent job of staying resilient here today. Notice the Russell 2000 was only down 0.33%. So today was largely a large cap sell-off, if you will. And again, it probably ties back into what we saw there with some of the nervousness around potential trade wars that might be flaring up after hearing some of the news about the tariffs on steel and aluminum. Let's go ahead and take a look at our next chart setup here. And this will be our 3 green arrows chart setup. Now, somewhat surprisingly, none of our 4 indices have 3 red arrows at this point. You would think after 3 ugly days that we've had, we might have seen enough pressure to push us into 3 red arrow territory, but we don't have that quite yet. We do have all 4 of these indices trading below their 30-day moving averages, so those arrows are all red across the board. But you'll notice that in all of the cases, the MACD and the stochastics still kind of remain in their bullish territory. They're very close, so I would say one more day of downside pressure in the market, and you'll likely find that the MACDs at least will start giving us some red arrows as soon as tomorrow. So we're going to keep our eye on that picture as well. Remember, if you are trend trading, that the 3 red arrows doesn't mean an automatic sell. It just is a reminder that we have some selling pressure that's taking place, and that's a great time to consider moving up your stop losses. So make sure you're following your plans out there. All right, let's take a look at a longer term view now. Remember, all the other charts that we've been looking at up until this point have been 3-month daily candle charts. This particular chart setup that I have here is going to be 3 years in length, and each one of the candles represent 1 week in time. And so as we look at this particular chart setup, it's called the 1040 crossover method, and we're using a 10-week moving average that's represented by this orange line that you see on the various charts, and we're comparing that to the 40-period moving average that's represented by this black line on these charts. What we're looking for are these crossover effects that'll take place. Remember, you don't see those very regularly. In fact, the last time we saw a crossover of those moving averages has been nearly 2 years ago in most of the cases here. If we go back as just one example on the Dow Jones, you can see the last time we had a crossover where that orange line went up and through the black line, it would have been back here in March of 2016. It would have been later March, so we're not quite to the 2-year anniversary of that, but we're knocking on the door of it. Again, we're not expecting to get out at the top or in at the bottom with this type of a setup right here. So just a reminder that this is something that you might want to consider for your longer term money, where maybe you're not quite as active as you would be with your normal options related trades. If we take a look now at our sectors 12 grid, this is where I do have to kill that camera feed so that way you guys can see all 12 of my charts here. Notice that I've got the S&P 500 pulled up in the upper left here, and then all the 11 charts that follow it represent the 11 sectors that make up the S&P 500. So as mentioned before, we do have a bearish posture now on the S&P 500 after this 3-day pullback that we've had here. And of course, with that moving average being red, it tells us that price is below that falling moving average right there. So as we start looking at some of the other sectors that make up the market, we can start seeing some kind of discrepancies, and that will normally be the case. Remember, not all sectors move together. One thing I should point out that I happen to notice here, let me pop over to the Market Watch tab for just a brief moment. Notice that we actually did have 2 sectors that closed in the green today. We had telecom and we had utilities. And both of those are very yield-oriented types of sectors, and so we'll find out here in a moment once we get to our intermarket analysis why that may have been the case here today. But just a reminder, not all sectors move with one another. Sometimes when we have those really ugly, like 4% sell-off days that we had a few weeks back, then of course we are going to see clean sweep, so to speak, with all the sectors really struggling. But on a day like today, maybe good to see some balance out there for those of you that might hold a diversified portfolio. It's possible that your utilities may have held up a little bit better than some of the other areas of the market that are a little bit more cyclical here today. So as we take a look at some of these other sectors, what might be catching your eye is that there are 3 charts that remain green even after the 3-day pullback we've had in the overall market. So we've got technology, which I'm kind of circling off here towards the left. That remains with a bullish posture. We still have that intermediate line at 85.8. It is falling, but remember, we consider anything above 80 to be bullish, so we give it a little bit of leeway up at those levels. If it continues to fall and then falls from 80 down to 79, that's a different story. Then it would turn to a bearish posture, but right now we would consider that to still be bullish. Now, somewhat interestingly, the other 2 charts that show up green are the 2 sectors that were actually up today. So as we look at the intermediate posture for telecom, it's at 49.27 and rising. And as we look at the intermediate posture or intermediate line on utilities, it's at 57.15 and rising. So whether you're looking at it on just a one-day basis today, both of those sectors being up, or an intermediate time period like these particular charts are showing us, you are starting to see some resiliency there. Now, obviously, some of you that believe price is king are going to struggle getting wildly bullish on those sectors right now. As you can see, prices are still largely trending lower over the last 3 months. So you don't want to go hog wild with that, but at a point, you have to start wondering, did things get a little bit overdone, especially with the utilities? You can see down below these utilities, it seemed like day after day after day we were getting some of those oversold cluster signals. And so maybe it's their time in the sun here for at least a little bit. Obviously, if you think interest rates are going to be spiking into the future, you're not going to want to get too crazy about that, but maybe on a week by week basis, you could do some swing trading off of some of those oversold areas. Otherwise, the rest of the charts from a sector perspective are bearish. Now, one I did want to identify here, because I'm going to be talking about it a little bit later with our trade application example, is going to be discretionary. Notice discretionary is this chart I'm kind of circling in the middle grouping right here. It did just recently turn to a bearish posture using that market forecast intermediate term line. You can also see that we have price below a falling moving average. So that moving average itself just turned red here within the last few days. It had been green and yellow prior to that. So starting to see some pressures on what had been one of the market's stronger sectors out there. So we'll take a look at that. In fact, I think there were some stocks, some retail-oriented stocks that were reporting after the bell tonight. Let me just quickly pop over to profit charts, and I want to type in JWN. And this is Nordstrom, of course, the big department store. And you will notice that after hours over here, it says that it's down about 3.33%. I think Gap might have reported as well. Now, Gap is up. Notice that Gap is up about 8%. So we got a little bit of a mixed bag after hours on some of those retail names. But from an intermediate term perspective, we can confirm that discretionary is starting to struggle a little bit. And you'll notice that its most recent high was not able to eclipse its prior high back over here. All right, let's go ahead and take a look at our next set of 12 grids. And this one's going to be our foreign markets 12 grid. As we take a look at this, you can see that there's just one holdout from a foreign markets perspective, at least of these 12 that I track here, that remains with a bullish posture. And when I looked at this earlier in the day, it was actually bearish, but it recovered enough on an intraday basis where it was able to retain its bullish posture, and that's Russia. You can see that Russia is sitting right there at that 30-day moving average as well. And so who knows, if you're looking for more of a bullish trade opportunity and you're trying to find pockets of relative outperformance, then maybe Russia is a place where you can start looking for some of those levels. Some of the other areas that we've been talking about recently, I had been bringing up South Africa, but it's not doing itself any favors. It continues to struggle at some of these horizontal resistance areas up here. It just doesn't want to seem to break through those levels right now. And some of the other areas, Germany was the one that was down the most today of these 12 charts. You can see down below here in the lower left, Germany is brushing up against 3-month lows. Now think about that for a second, because remember that the S&P 500 has indeed fallen 3 days in a row. Those have been some ugly days. But if we compare that, let me just pull up the S&P 500 here next to it to make the comparison easier. We're still well above where we bottomed out back here in early February. Germany, on the other hand, is really struggling. It's basically sitting at some of those levels where we were in early February and is in significant jeopardy of really breaking down and through those support areas. So again, we're going to have to be careful there if you're interested in some of those European equities. Let's go ahead and take a look now at our final 12 grid. And as I pull this up, notice that we do have a lot more bullish charts here, and that's kind of by design. Remember that this particular set of 12 grids, which I call my inner market analysis 12 grids, is not going to focus exclusively on stocks. And so oftentimes you'll find that money starts rotating from the stock market to potentially commodities or potentially bonds or other things that are not stock oriented. So as we look at this, we do have a few more things to focus on if you prefer being on the bullish side of the equation than the bearish side of the equation with your own trading. One thing I did want to point out, since interest rates have been kind of a story for the market here recently, notice that interest rates have come down in touch. And this is the yields. I should be careful on how I say that. The yield of the 10-year U.S. Treasury notes. You notice that we're touching the 30-day moving average right now. Now, that hasn't happened since December, basically going all the way back over here. So after we had this huge move higher in rates, we kind of got within just a stone's throw of that 3% and then rejected it. We've had a pretty significant pullback from those levels. We're now sitting at that rising 30-day moving average, so we could very well find some support at these levels, but it has been a fairly decent pullback, and that's kind of harkens back to what I mentioned a moment ago with the sectors. That's part of the reason that you found the utilities withstanding the overall broad market pressures today. Remember, utilities are very interest rate sensitive, so when interest rates fall, like we saw here today, you'll find that utilities are oftentimes outperformers compared to the rest of the sectors that are out there. You'll notice that the VIX had a pretty big day. No surprise there. VIX was up 13%. Remember, VIX is inversely correlated to the S&P 500, so that is what we would anticipate. But I'll tell you, the chart on this 12 grid that really catches my eye more than the rest, and this is not one that we've talked about here very recently, and so let's kind of focus our attention down below here. This is your agricultural commodities, ticker symbol DBA is the way that you can track that. And if I right click and go to maximize sell, it's been quietly holding its own here for the last, let's call it a month and a half, maybe 2 months. But today we had really outsized move higher here on the agricultural fund. So we want to keep our eye on that. I don't know if maybe today's trade news tied into that a little bit with some of those grains, but that's an area that if you're nervous about what's happening with some of the stocks out there, you know, it's possible that some of that money is rotating into some of these agricultural commodities, but that's a fairly decent looking chart here after being quiet for quite some time. So let's keep our eye on agriculture. Now, speaking of commodities, I did want to come over here one more time to the Market Watch tab, and I wanted to point out something that was kind of interesting, at least in my eyes. If we come over here to the S&P 500 materials, now remember, this is a personal watch list here, so you do have to build these out on your own. They don't come pre-populated with the Thinkorswim platform. But notice that, you know, if we take a look at this and we kind of look at the sub-industry here, we now only have one steel stock left in the S&P 500. Purely steel stock is Nucor. All the rest have been kicked out or demoted because steel stocks have done pretty poorly over the years, and so their market caps have been reduced to levels where they've been kicked out of the S&P 500 and moved down to the mid-cap space. So when we saw a lot of the steel players do well today, it really didn't help XLB, which tracks the materials within the S&P 500. It would have helped it a lot more in years past when there was a lot more steel exposure. But as it stands, XLB actually did poorly today because it has a very small amount of steel. Now, I do happen to have the mid-cap 500, or the mid-cap 400, I should say, in a separate watch list. If I could find it here, there it is. And if I sort by sub-industry here, we can see that if you're looking for exposure to the steel space, there's a lot more steel opportunities in the mid-cap space. So you can see here a handful of names: Steel Dynamics, Reliance, United States Steel or US Steel, which is ticker symbol X, Allegheny Technologies, Commercial Metals, Carpenter Tech, and Worthington. And most of those were up today with the exception of Allegheny was down 1%. But otherwise, we had moves like 4%. out of Steel Dynamics. Reliance Steel up almost 4%. U.S. Steel up nearly 6%. Commercial Metals up over 5%, and so on. So if you're looking for some exposure to the potential news that we heard today regarding some of those tariffs, you might want to explore a few of those names that I just mentioned right there as well. All right, so let's go ahead and now take a look at our trade application example here for the day. And as mentioned before, we have a somewhat new bearish posture on the S&P 500 according to that intermediate term line. As you can see here, I've got that S&P 500 pulled up. If we take it a step further, we can now see that the consumer discretionary space, XLY, is now also giving us a bearish posture, starting to roll over here, and has a bearish posture according to that intermediate term line down below. So our trade application example today is going to focus on that area, and the chart that I wanted to explore a little bit here was Marriott. Now Marriott has actually been an outstanding stock for quite some time. If we go back on a longer term perspective, let's pull up a 5-year chart. You can see that starting here in about October of 2016 to about 2 months ago, this thing was in a very significant uptrend. We went from about 67 all the way up here to 150. So I don't want this to seem like I'm bearish on Marriott from a longer term perspective. You can still see that that trend is firmly intact. But if we start narrowing things down here to a more of a 3-month daily candle chart perspective, you can see that the picture does change. After topping out here at 149 on January 30th, we've really struggled to regain those levels. Now, it's not its fault entirely. Remember, the entire market has struggled to retain or to eclipse those prior levels. But this one has really tracked sideways here for the last couple of weeks, where the rest of the market was trying to move its way higher. And so you can see here we went right to that 30-day moving average. We rejected it, and we really started spilling over at a more aggressive level today. Marriott was down 2.6% today, much worse than the broad market indices themselves. Now notice that that's also a bearish candle that you're seeing right there as well, a bearish engulfing candle. And you're also finding that that moving average line has colored itself red now, telling us that price is below a falling moving average, whereas in the past that moving average had been rising. So a couple different elements there that suggest that Marriott is struggling to some degree. We don't want to get too aggressive with it at the same time, and so I thought what we would do is maybe a higher probability bear call spread on this one. By the way, that reminds me, a few weeks back we did sell a bear call spread on SPY in this market outlook video, and I did notice that today we were able to buy that back at 80% of max gain. So again, having a little bit of that bearish exposure does help when we have these days like we've seen here recently. All right, let's go ahead and take a look at our trade tab on Marriott. And you can see that if we go out here to April, we do have a number of contracts that are a number of strikes that have open interest in the thousands of contracts here. So some decent liquidity on this largest hotelier, at least here in the United States. What I'm going to do is I'm going to try to focus on the 30 delta, and you can see right here we do have one spot on a 30 delta, and that's our 145 strike. So I'm going to right click on the 145. I'm going to go to sell vertical. I've got that pulled up down below. So I've got a 145, 150. Remember, a lot of times when stocks get to levels such as $137 like we see here, a lot of times you will find that those strike prices will be $5 wide. So don't be too concerned when you see something like that. More important is, are we getting enough return on risk to make the trade worthwhile? So you can see here that we're getting $1.17 to potentially sell this trade here in paper money. If I ever wanted to see what our return on risk is, an easy way to do that is click confirm and send once here on paper money. And then I'm going to get my calculator out, and let's take a look at our max profit of $117 if we were to do just one contract here, divide it by our max loss, which would be $383, and you can see that our return on risk is just a hair above 30%. And that's generally what we're shooting for as a reasonable place to start our consideration for these out of the money bear call spreads. Okay, now to catch the rest of you up to speed, I know many of you are very familiar with options trading, but we do get new students to watch these videos on a regular basis. What I'm really trying to accomplish here is hoping that Marriott does not go up dramatically from these levels between now and the April expiration here at 50 days from now. So we have a number of possibilities. This stock right here that's trading at 137 could go sideways in the next 50 days and we'd be good. It could go down, which right now we have some bearish signs from a technical analysis perspective, which could entirely happen. And so if that happens, we'd make money on the trade as well. And it can also go up. We just can't have it go up a lot. 145 is basically our line in the sand. Technically, 145 plus $1.17 will give us a little bit more wiggle room there from a break-even price perspective. But as long as we don't think that this stock is going to go up, let's say $10 per share in the next 50 days, we stand a reasonable chance of making some money on this trade. Now, another thing that you can do is when you have that trade loaded up down below, you can right-click and go to Analyze Trade. So I'm going to click on that now. That brings me over to the Analyze tab. Now, for some reason, it brought me over to the Fundamentals. That must have been where I left my Analyze tab last time. So you would probably have to come back over here to the Risk Profile, like I've just clicked on right there. All right, now that I've done this, notice it kind of gives us this Risk Profile graph to give us a better idea of some of the numbers that we might want to consider as we're thinking about taking a trade like this. Now, one of the things that I like to do is come down below. We have these little drop-down menus off to the right here. And if you click on the first one, you can go to Set Slices to break even on the date that your contracts expire, which it has right here for us, 4/21 of 2018. So I'm going to click on that. That then puts this price slice on this risk profile here for us at right around where our break-even price would be. And then it gives us a reasonable expectation of what our probabilities of success would be on this. We're at about 71% chance of making some money on this trade, about a 29% chance of losing money on this trade. So again, a little bit better than a coin flip, not 100% though. One other thing that is nice about this risk profile is that you can then take that slice, again, that's that dotted vertical line that we see right there that represents our break even on this trade. And if I click on this drop down again and I go to Slices to Charts, and then I come over here and click on the box in the upper left here of this grid, what it'll do is it'll take that once vertical line and flip it horizontally to put onto a price chart for us. This helps us visually identify whether we still think it's a reasonably strong looking trade candidate or not. What it's telling us is, again, do you expect this stock to be up and above this purple dashed line right here during the April expiration? If the answer for whatever reason is yes, then you're probably not going to want to take this trade. On the other hand, if you believe that this particular stock will stay below this purple line for the next 50 days, then this could be a reasonable trade to put in your paper money account as well to start getting some practice with some of these bearish trade opportunities. Remember, we got to shake that rust off at some point, whether it's now, whether it's later this year, whether it's a year from now. We're going to have a bear market again at some point. You don't want to be caught blindsided by that. So if you only know how to do bullish trades at this point, you got to start forcing yourself to start making some of these practice trades. After all, that's what paper money is all about, starting to shake some of that rust off, and that way you'll be in fighting shape once the bear market eventually does rear its ugly head. So with that, let me go back over here to the trade tab. I am going to put that trade in, confirm and send that off. All right, so to summarize, we had our third straight down day for the S&P 500. Generally don't see a whole lot of sell-off days represented on the first day of the month for those of you that track the Stock Traders Almanac information, so that was somewhat interesting. And also we find that March and April are generally very positive months. And so we'll have to see if this year brings about a different set of circumstances or not. Certainly anything can happen, as we saw with today's trade news and some of the tariffs on the steel and aluminum industry. So with that, I want to wish you all the best with your trades and your investments. And David will be with you tomorrow, and I'll be back with you next week. So have a great weekend, everybody. Take care. Bye-bye.